Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at LM Funding America.
If you find our talks useful, please consider subscribing, liking, and commenting underneath to support our work. And if there's any stock you want us to look into, leave it in the comments section below.
So let's get into the analysis. We're talking about a company that has made, one of the most aggressive pivots we've seen in a while.
A pivot centered on a massive balance sheet discount rate.
Exactly. LM Funding America has basically shifted its whole identity. They've moved from specialty finance,
It is a pretty niche world.
a very niche world, into the high-octane sector of Bitcoin mining.
And when you say aggressive, you really mean it. This isn't just them dipping a toe in the water. Mining is their core growth engine now.
It is. They're all in chasing those Bitcoin blocks.
But a shift that dramatic, it must require just a huge amount of capital. And with crypto being so volatile, how does that transition actually look on the books right now?
It looks like a lot of high-growth spending mixed with some, let's call it legacy drag. So for the trailing 12 months, the TTM ending September 30, 2025,
Okay.
the company reported $7.57 million in revenue. It's a decent baseline.
But the margin is what matters in mining.
Right. And that's the key. They pulled in a gross profit of $1.29 million, which gives them a gross margin of about 16.99%.
Almost 17%. So that shows they can run the physical operation efficiently, which is absolutely critical in this space.
It is. But as you said, growth is expensive. And if you zoom out, no, they're not profitable.
That yet?
Not even close. They are aggressively burning cash to build out that future capacity. The TTM net losses were at a pretty challenging negative $13.83 million.
And what's that per share?
That translates to an EPS of negative $1.13. And most of that is from just high operational and other expenses, setup costs for the pivot, about $15.11 million.
Wait, if the losses are that steep, nearly $14 million in a year, doesn't that justify the market just ignoring whatever assets they have? How do they stop that cash burn?
That is the core skepticism, and it's exactly why the stock trades where it does. But, and this is important, they are already showing really smart operational control to manage that risk.
How so?
Well, for example, in their November 2025 update, they mentioned they were doing strategic energy curtailment.
Okay, break that down for us. That's a key detail.
For sure. In mining, power is your number one cost, always. So when the grid prices spike, say, during a heat wave or something, LM Funding America can just shut off its miners.
And then they sell that power back to the grid.
They sell that reserved energy right back. And that one move generated $76,000 in sales in just 1 month. It diversifies their revenue, and it hedges against those crazy energy costs.
So they're turning a volatile expense into a controllable revenue stream. That's smart. It shows they get the utility business, not just the crypto business.
Precisely. Now let's look past those TTM losses for a second, because the core investment idea here, it hinges entirely on the balance sheet.
Not the current income statement.
Not at all.
Okay, so this is where the contradiction comes in. You have this painful net profit margin, what was it, minus 182%.
That's the one.
But you're saying the underlying financial health is actually good. Where is that strength hiding?
It's hiding in their lack of crushing debt. Compared to their peers in the mining industry who are just borrowing like crazy to buy new rigs.
Right, they're always highly leveraged.
Always. But LM Funding America keeps a very low leverage profile. Their debt-to-equity ratio is only 16.2%.
A 16.2 DE ratio in a sector known for 100, 200% leverage. That is huge. It means their growth isn't totally reliant on risky loans.
It gives them a safety cushion. And this low leverage, it kind of sets the stage for the real aha moment for you, the investor.
Which is the massive asset undervaluation.
The one the market is completely overlooking right now.
The hidden treasure. Let's get into the details of that Bitcoin treasury, because this is the whole reason anyone would look past that $13 million loss.
Okay, so as of November 30, 2025, the company holds 301.8 Bitcoin.
301.8 BTC. And at recent prices, what's that worth?
That treasury, on its own, is valued at $27.5 million.
$27.5 million in a highly liquid hard asset. Okay, so what does that mean when we look at the share price? This is where the arbitrage comes in.
Right. It translates to $2.25 per share. If you just divide that treasury value by the share count, that is the hard asset value backing every single share.
And the stock was recently trading at, what, 99 cents?
The math is, well, it's staggering. You buy one share at 99 cents, and you are effectively buying $2.25 worth of liquid Bitcoin.
So the market is valuing this vault at less than 50 cents on the dollar.
It is. And it's basically giving you the entire future mining operation, all the infrastructure. It's giving you all that for free and still handing you a discount on the Bitcoin they already own.
A discount like that seems almost unbelievable. What is the market pricing in that makes it ignore $2.25 in hard value? It must just be fear that the operational losses will eat that vault.
That's the core risk, absolutely. And it puts the spotlight right back on their operational edge, their moat. They have to prove they can scale efficiently.
So how are they building that moat? You hear vertically integrated mining a lot, but why is that better than just leasing space somewhere else?
Vertical integration just means total control. They own the infrastructure, specifically that 15-megawatt facility in Oklahoma. They aren't a hostage to third-party hosting fees.
Which can change unexpectedly.
Exactly, and it's a major expense for other miners.
Yeah.
But it's not just owning the building, it's the tech inside.
What are they using?
They're deploying things like BC40 Elite fog ashing units, which use immersion cooling.
Okay, and that's important because...
Because immersion cooling is way more energy efficient. It also extends the life of the miners themselves. So it lowers both your operating costs and your long-term capital costs. That's how they can do that energy curtailment we talked about. They control everything.
Controlling costs is one thing, but you need growth to justify this whole thesis. How aggressive is the scaling plan?
Incredibly aggressive. They're targeting a rapid expansion to 780 petahashes per second, or PHs.
780. And for perspective,
that's a projected 75% increase in their hash rate compared to 2024. They are moving very, very fast.
a 75% boost in capability. That's how you convince the market the discount is wrong. But that kind of growth, it needs cash. Which brings us to that recent capital raise that scared everyone.
Right. They just did a $6.5 million offering. It was a mix of shares and warrants, effective at about 71 cents.
And the purpose of the raise is key here.
It is. The money is specifically for funding that hash rate growth. It ensures the Oklahoma expansion can happen debt-free.
So it's good dilution.
Yeah.
They're not just plugging a hole. They're raising money to buy assets that will generate future revenue.
Exactly. It fits right in with their low-debt philosophy. They're using the market to fuel growth, which should, ultimately justify a higher valuation.
All right, let's shift to the technical picture, because the market often shoots first and asks questions later with dilution news.
It certainly did here. After that $6.5 million offering was announced, we saw an immediate bearish reaction. The stock dropped 17% on those fears.
But that drop to around 99 cents could be a bottom.
Some analysts are seeing it as a potential capitulation low, yeah. A strong base being formed.
So where are the key technical levels for you to watch right now?
Well, the offering basically set the floor. So your strongest support is right around that offering price, 0.71 cents. A bit higher up, you have support at $0.87, which is the new warrant exercise price.
So the downside risk is pretty well defined relative to that $2.25 in assets.
It is. And the upside target. The first real test is at prior resistance level, right around the $1.50 mark. If it can break that, it would signal a pretty significant trend reversal.
And momentum-wise, the stock has been just off it over the last year. It's showing, what, a negative 74.1% return?
It's been a dog, for sure. But the recent sell-off might have reset things. Weekly volatility is up at 16%, which can suggest accumulation, smart money moving in.
And the RSI.
That sharp 25% plunge pushed the relative strength index deep into oversold territory. So you have a technical reset plus the asset value. It's a very attractive, if, high-risk setup.
Okay, so we've got the bearish sentiment from the capital raise clashing with the bullish strength of the vault. Let's nail down the immediate catalyst that could shift that sentiment.
There are 3 critical near-term events for you to watch. First is the formal closing of that $6.5 million offering. That should be around December 22nd. It just removes the uncertainty.
Second is the shareholder vote.
Exactly. A huge stockholder vote on repricing the warrants. This could drop the exercise price for about 3.5 million shares from $2.95 all the way down to $0.87.
Which would make it much more attractive for holders to convert.
Right. It brings in more capital and simplifies the share structure. And third, and maybe most important, is the operational catalyst.
Proving the growth story is real.
That's the one. The full energization of the second unit at the Oklahoma facility. This is the tangible proof that they're on track for that 780 PHs target.
We've talked about the dilution risk, and those 9.15 million warrants create an overhang. Is there another primary risk here?
The warrants of pressure, yeah, but the funds enable growth that should absorb that. So the primary risk really remains execution. Can they deploy that hash rate fast enough to outpace the operational losses?
If they lag on that 780 target, the cash burn continues.
And the market will punish them for it. But they have some powerful tailwinds. You've got the Bitcoin halving afterglow, which is historically great for miners.
Plus the whole macro picture, potential rate cuts.
Both of those support the upside. Rate cuts boost growth stocks and crypto miners specifically. You could see a big sector rotation into these undervalued Bitcoin-heavy companies.
Okay, let's bring it all together. What is the final crystallized investment thesis here? And what's the time frame you're looking at?
The elevator pitch is that LM Funding America is trading at a jaw-dropping discount. Its liquid assets, at $2.25 of a share, are more than double its stock price, while it's also executing an aggressive, debt-free scaling plan.
It's a classic value play, hiding inside a volatile growth sector. You've got the discount, plus the scaling to 780 PHs. It's set up for huge upside if management executes.
Correct. And if these catalysts all hit, the financing closes, the warrants get restructured, and they confirm the scaling, the market should start to reflect that value around the Q1 2026 earnings report.
So a 3 to 6 month horizon.
That's the window we're looking at.
The volatility is high, the upside is substantial, and the foundation is built on liquid crypto assets. The real question for investors here is whether the market will finally catch up to the value locked in the vault, or if operational losses will continue to overshadow that Bitcoin treasure until it's too late.
A critical thought to chew on indeed. If you want to keep up with our analysis of fascinating stocks and market catalysts, please remember to subscribe and turn on notifications so you don't miss our next talk.